Good morning, traders. Today we are breaking down gold. Despite the massive geopolitical escalation in the Middle East, the safe haven flows we would typically expect to see flooding into gold are actually poured into the US dollar for a change. The dollar strengthening across the board, gold took a serious hit yesterday, falling about 5%, but found a floor at the psychological 5,000 level, which is also the 50 Fibonacci retracement of the leg from the record high of 5,600 down to the 4,400, let's just call it. So the macro drop is complicated. Yes, the Strait of Hormuz is effectively closed, and the IRGC, the Iranian IRGC, has threatened to block all oil leaving the region, which is, of course, a massive escalation. But this shock is inherently inflationary. Okay, and this was reinforced by the recent US PPI data, which came in hotter than expected at 2.9 year over year, and that was higher than the forecast at 2.6. High energy price, of course, mean higher inflation, and higher inflation means the Fed cannot really cut rates. In fact, if we look at the CME Fed Watch tool, the chances of a Fed holding rates steady have actually spiked. Markets are now pricing in perhaps just one rate cut for this entire year, likely pushed all the way back out to the last quarter of 2026. This higher for longer rate environment is what is driving the dollar up, of course, and pushing gold down in the short term, because let's not forget it's gold against the dollar. So let's look at the charts now to see how this is playing out. We are looking at the 4 hour, and we see this aggressive sort of move to the downside, which found perfect support at the 5,000 level. Okay, well, this is a cluster. Let's not forget. So it's not going to be easy to break, and that is probably why we see currently this leg to the upside. However, the other side did not reach oversold. So there is a risk, potential risk for further decline. And if this decline took place before we moved above the 5,260, the previous low here, then it would probably create a 5 wave leg to the downside. 5 legs typically are followed by corrections and further declines. If we're to see something like this, we would see probably an ABC correction or perhaps a new leg to the downside. Now, why am I pointing to the 23.6 Fibonacci? Because the move that we saw to the upside following this ascending triangle breakout stopped at 5,400, which is the 78.6 Fibonacci retracement. Now, if we're going to see this price action continuing in this rhythm, it means that the level that we have to pay attention to is going to be the 23.6 Fibonacci at 4,680. Excuse me. And why? Well, because it is the mirror correction. The 78.6 is the mirror correction of the 23, pretty much. Okay, let's just say 22.4. This would suggest, guys, that this might turn into a pennant and we're going to see prices continue high, or maybe even if we start consolidating further, it could be a triangle and then we'll continue higher. But this is more of a medium to long term play, let's just say. Actually, maybe medium term, not long term. In the shorter term, however, okay, we are supposed to look at the corrective leg, this, and see that we have had a kind of initially a dead cat bounce that we thought that would continue lower, but it didn't, right? So initially, now what we're looking is a mini version of this, okay? We're looking perhaps at a mini dead cat bounce, which if we come closer to and zoom in a little bit, we're going to see that currently the correction we see comes to around the 38 and 50 Fibonacci, with the 50 Fibonacci being at 5,200. So let me tell you this, that as long as we are below the 50, there is a chance for further decline to either a fifth wave, a corrective wave, and then continuation, or either way, it would really take away the corrective part of this particular structure. The corrective part would mean that prices will continue and retest the previous low. This would be a corrective structure. So for now, we have an impulsive structure to the downside with both meaning there could still be downside. Even if we do see a corrective structure, for example, we could still go lower down, because let's not forget, if this is a pennant or essentially ends up being a triangle, we're still looking at a corrective leg here, okay? Whatever that may be, any form it has. The important thing is that we are below the 50% in order to actually see further downside. So patience here, I think it's key. If we push above the 61.8, okay, we could, which is the previous low over here, so we could see this accelerated to the upside. It would essentially revive the chances that this triangle is indeed still playing out. Let's not forget that the invalidation level for this triangle, the ascending triangle that we've been actually watching for a while, is at 4,858.60, let's call it, which is at 38.2 Fibonacci. Why? Because this is the line in the sand for the triangle pattern to either play out or not. So until we are above this level, guys, we can still consider this move to the downside as a corrective leg. Essentially, what we would be looking is, this is a 5-wave move to the upside. We found initial support, and this is a correction. The correction might have ended here if we break above the 61.8, or if we didn't, maybe we're going to see this still playing out to here. But as long as we are above that level, we can still go higher. If we don't, then probably we're going to see this going lower down. Now, pay attention to this. It's very important. This candle over here, where we have actually come and found resistance, it was used like a liquidity sweep. This was the January 29 initiation of the huge dump we saw in gold, which fell like 10% or whatever for the next following sessions. So it was naturally expected that we're going to revisit this level. That's why we marked it in our previous video as well, and also in our weekly analysis. So for me, the game plan is, I wouldn't say easy, but it really depends on how patient you are as well. If you're looking to trade this now, you know, you could go either, you could long to the 61.8 or short to the previous low. So this is a situation where it's a bit unclear. So it's not really a good, ideal scenario. But if we do form a lower low over here, then that would make a better opportunity to not go short just in the short term. For example, something like this, we long the correction, but we also can short the next leg to the downside. If we see 5 legs down, it's unlikely that this is going to stop here and revert. Okay. So I would suggest a little bit of waiting, because the reality is that if we do lose the 5K as well, this would open the door to wave E. Okay. And this would invalidate the bullish setup entirely. Unless if, of course, we consider these as a potential pennant, which is going to end at 4,680, and then we should to the upside. So that's for today. Trade safe, and we'll be here again soon.